Hi, welcome to Slay the Spider. I'm Jim B, and I'm the creator and host of Slay the Spider. Shares of the S&P 500 are called S&P Depository Receipts, SPDRs. Spiders. Slay the Spider means I intend to beat the S&P 500 quite substantially. There are three major influences on the movement of stock price, according to a study by Ben E. King. 80% of your investment success will be due to the movement of the sector and the market. Now you can view a weekly snapshot image of the market and the sectors. This is a snapshot from April 9th, 2021. The red arrow, pointing towards the 2 o'clock position, represents the market. The rectangles each represent a mini-sector. They are color-coded to the sector they represent. Healthcare mini-sectors are in red, technology is dark blue, financials are green, media communications are brown, industrials are purple, consumer discretionary are light blue, and all the others are gray. I've been charting this movement since 1998 over more than 25 cycles using this exact mix of 40 mini-sectors. The key to understanding the movement and what makes the cycle predictable are the psychological stages that investors experience as they go through complete market cycles. It rarely changes. These stages are on the outside border of the circle. The placement of the sectors and the market are completely data driven. The interpretation of what to expect next is from my experience of going through the cycle dozens of times. I'm not always perfect, but the beauty of the circle is that it corrects me quickly when I don't get my prediction absolutely correct. I've learned it's okay to be wrong now and then, but absolutely abysmal to stay wrong when the data says otherwise. The movement in the sectors this past week were quite sharply down. First, in the health sector, drugs declined, biogenetics declined, and healthcare declined. All are still on the bull side. In media communications, internet declined, media declined, and telephones declined. All three stayed on the bull side. In technology, software declined, semiconductors declined, computers declined, and electronics declined. In consumer discretionary, retail and autos crossed to the bear side and declined. Leisure declined, household products were unchanged, gaming declined, and restaurants declined. In financials, Wall Street declined, real estate declined slightly but went unchanged on the chart, insurance declined, finance declined, savings and loans declined, and banks declined. In the industrials, waste was unchanged, aero defense was down, steel rose slightly, chemicals declined, building products declined, metals declined, and machinery tools declined. In the others group, on the bullish side, food declined, gas utilities rose, protection safety declined, oil declined and joined oil services by crossing to the bear side. On the bear side, forest products and precious metals were both unchanged. Electric utilities declined, transports fell, textiles declined, transports declined, business products declined, and oil services also declined. This week, four mini-sectors remained unchanged, three rose, and 33 mini-sectors declined. Autos, retail, and oil crossed from the bull to the bear side this week. We now have 13 sectors on the bull side and 27 on the bear side. For the week ending July 9th, the Dow was up 83.8%, or about a quarter of a percent. The S&P 500 was up 17 points, or 0.4%, and NASDAQ was up 62.5, or 0.43%. Despite the markets being up this week, 366 stocks went from buy to sell signals. The overall market score was 75 last week, and this week it's 59. Since February 12th, 1,306 stocks of the 6,320 in my database have gone from buy to sell signals, or about 20, a little over 20%. Last week, over 425 stocks of the 6,320 went from buy to sell signals on less than a 1.5% market downturn over about a day and a half. About 60 went back from sells to buys in the subsequent 1% market rally, so net 366 stocks went to sell signals. Of the 6,300 stocks in the database, there are currently 3,320 buys and exactly 3,000 sells. It will take just 160 more stocks to move from buy to sell, and more than half will be on sell signals. The question is, how much risk are you taking on your stocks, your stock ETFs, or stock mutual funds? If the market drops 27% in 6 days like in March of 2000, or 31% like in September 2008 in 16 days, how much time will you lose just to get back to even? A year? 2 years? I cashed out early for a reason. It's easier to do so early and much less stressful. My point is, markets move down much faster than up. Now I have 2 to 3% at risk using options, but that's the maximum amount I can lose no matter what happens. I've missed out on 8% of gains by going out early. My options will make that up and more in a week or so once this market turns south. I won't have to wait a year or two to be where I am now. I'll be far ahead of the S&P 500 performance. It's how I intend to slay the SPiDeR. Paid subscriptions are now available. $15 a month on a month-to-month basis. $12 a month on an annual subscription, $144. And there's a 90-day free trial. Thanks for watching my Slay the SPiDeR video this week. For those of you who are new, so far this year we've gone through about 8 of the events on the Slay the SPiDeR circle, and I called all 8 of them correctly. And for those of you who watched everything since January, you're welcome. See you next week. Thanks. Bye.